Good morning. It's me again, Mike Head from Ethical Screening, and I'm talking this morning to Marcus from Schroder. If you can introduce yourself, then we'll get on to what we're going to talk about.
Sure. Good morning, Mike. Pleasure to meet you. My name is Marcus Jennings. I'm a fixed income strategist on the global unconstrained team at Schroders. Been on the desk for a number of years now, but I also think about ESG and sustainability within my role as well. And I've been quite pivotal in the sense of creating some sustainable strategies, which I'm no doubt we'll talk about later today. But yeah, that's taken my interest over the last couple of years as well.
So how long have you been at Schroder in total, and always in fixed income?
Not always in fixed income. I actually started on the graduate program, we're going back a while now, 2015, I think it was. And I did around 2 years on the graduate program in the economics team. That gave me a good foundation for learning about economics in a market sense. And now, since, I think 2 years elapsed since I started. And then ever since then, I've been on fixed income team, looking at certain regional markets from a traditional investment sense. But as I just said, certainly over the last 3 to 4 years, I've taken quite a keen interest in sustainability, and ESG is sort of grown in our industry as a whole.
And is that a personal interest or oh, Schroder, we're going to suggest that you're interested in it, Marcus type thing?
A bit of both, but certainly, even from my times when I was on the economics desk, one of the first projects I was involved with was looking at the impact climate change may have on global economies, really. And I think even from that point on, which was very early on in my career, I sort of was very interested in ESG dynamics and how it could impact sovereigns. And I realized that not a lot of people were looking at it as well, and it was a very undiscovered area of the market as well. So that was a particular curiosity of mine as well.
It's quite interesting that it just sort of reinforces how this is, in some ways, we've known about it for a long time, but in terms of where people are going, when that penny drops, it's kind of interesting that it hasn't dropped as quickly perhaps as it should have done. And as you say, you were one of the first to come at it, and you think, really? So what were the others not noticing that and now, of course, it's becoming much more common, although there aren't that many offerings at the same time.
Yeah, I think the simple fact of the matter is that sovereign ESG is very difficult to do, and coming up with a credible strategy that takes into account ESG factors and fitting that into a traditional investment lens or an investment approach is not easy. Now, we feel like we've sort of come up with a potential solution, and it's by no means necessarily perfect, and it won't tick everyone's boxes, but we think we've gone at least some way to try and correct some of the problems, maybe the existing approach the industry has taken to ESG in the sovereign space. I think the World Bank talked about a few things really that was really challenging from an ESG point of view for sovereigns, at least. Things like there's generally a lack of clarity and transparency around what is sovereign ESG, what does it mean for portfolio outcomes. Another big issue is actually there's a very big income bias associated with ESG scoring. And when I say income bias, what I'm really meaning is that rich countries tend to score very well relative to emerging market countries. And if you think about it, they're probably the countries that need the capital in the first place to make the transition to a broader, more sustainable global economy. So coming back to sort of our approach, we think we've at least gone some way to try and correct for these sort of should we say incorrect interpretations of sovereign ESG.
I mean, it's an interesting. I saw a presentation from an organisation who have an exclusively emerging market sovereign debt fund, and thought, wow, there's quite a lot to unpick there, isn't there? And of course, as you say, there's this desperate need, and at the same time, how do I say this nicely? We tend to apply a developed world view of developing economies that's not actually necessarily fair.
Yeah, very true. And there's a question that comes up from time to time in terms of why have we chosen certain data sources to define our screening process, for example? Does it have a certain Western lens to it? I think there is an element of that, but I have correlated our existing approach with other data providers such as the World Bank, which hopefully you'd think would take a more holistic and more balanced view to thinking about ESG really more broadly.
And I think the other thing is, as you say, not everyone is going to agree with what you're doing at the moment. But I think it's fair to say that what you're doing at the moment won't be the same in 2 or 3 years' time, because a lot of people's views will have changed, and also information will have changed, and so will the state of the world.
Very true. And we have to sort of be very aware of how political cycles may change and what that might mean for the sustainability credentials of certain countries. But I think to your earlier point on something like data, I think this is something that is very much growing at a reasonable pace actually in the sovereign space, whereby there's clearly a demand for sustainable sovereign solutions. But the thing that's really been holding investors back has been the data availability. Now, again, I don't think we have all the answers here and now, but I would like to think that over the next 3 to 5 years, more data providers will be able to give us, more data and, importantly, more up-to-date data on sovereign metrics, whether that is climate commitments, carbon emissions output, or health outcomes for countries. But certainly, data is an issue and continues to be an issue. But I'd like to think in the future that that will change as there's clearly demand for it.
Do you think as well that there's going to be, because you get that concern with corporates around reputational risk, as in you don't want to be seen to be going in the wrong direction or a naysayer, etc. Do you think that will start to have an impact politically in terms of sovereigns?
I think it already is having an impact, and I think it's just important to stress. The views expressing here are related to the fund specifically, the sustainability criteria that we've chosen, and it's not a Schroders wide view by any stretch. I think I just wanted to stress that point. It's certainly the approach we've taken has very much resonated with clients, but as you say, may be different to other people's views. But certainly politics does come into things, and that's where it can be a bit grey and a bit of a murky area. But I think we've tried to be relatively clear cut with respect to how we define a sustainable sovereign or not, and with that it takes the sort of the grey area out of it, and hopefully some of the politics with it.
So, on that point, how do you define a sustainable sovereign, or how do you grade these things? Because there's the views of different governments obviously change as different governments change.
Sure. This is sort of the $1 million question, so to speak. Fundamentally, we have a three-pillar approach to our stance when it comes to defining sustainability and whether a sovereign is sustainable or not. The first one of those very much focuses around sustainable development goal performance. And ultimately, within that pillar, what we're really trying to see is really good progress towards the sustainable development goals, really. We chose those, not only are they well known outside of the investment community base, but also if you think about it, back in 2015 when they were set, they were the definition of sustainable development. So we thought that was a great starting point. But fundamentally, we really want to see countries making good progress towards the sustainable development goals. I think an important point to this point is actually that we actually try to adjust for the bias associated with SDG scores, i.e., as you'd expect, rich countries tend to have higher scores, SDG achievement relative to emerging markets. And we make an adjustment within our framework to try and level the playing field for DM versus emerging markets. So that's sort of the first stance, really, in the first pillar. You've got to be doing well with respect to the SDGs. The second really focuses around climate commitments. Now, I think climate pledges can sometimes be cheap in the sovereign space. You can throw out a pledge for 30, 40 years' time, but the hard part is really coming up with a plan to really get to that net zero commitment in, let's say, 2050. So ultimately, what we want to see is actually that sovereigns have thought about the transition pathway. They've published NDCs to go alongside their pledge, and have fundamentally come up with a policy document that details their transition plan going forward. So for us, it's not sufficient for a country just to have a pledge on the climate side. They've really got to think about it. And then the final aspect really is just thinking about people's rights, civil liberties, and so on and so forth. We think that certainly over the medium to long run, countries whose citizens have high levels of political rights and enjoy high levels of civil liberties provide an economic backdrop and framework for stable long run growth. And ultimately, that is a positive for bond investors such as ourselves, really. So we're really looking for countries that are free in this sense. And importantly, I think that's an important point to stress. Rich countries that are mostly free have probably been able to do this because they have high levels of political freedoms and so on and so forth.
You mentioned about clients being clients. Are you talking individual clients, corporate clients, charities, where pension funds? Who is showing the first interest in the fund?
I think interest has been reasonably broad, but certainly the intermediary market has taken a particular interest in this. Fundamentally, I think the client type for this is someone who's invested or interested in sustainability. They likely have their solution when it comes to credit, equities, or broader risk assets. But when it comes to their risk off proxy, that they probably don't have a well-developed, sustainable solution on that front. So that's been fine in an environment whereby risk assets have done well, and admittedly, bonds haven't necessarily played their safe haven status lately. But we think that with inflation sort of slowly returning to target, that safe haven status for bonds will return, and it's probably a great opportunity for clients, prospects, and the like who are looking for a sustainable solution that protects them in a traditional risk-off environment to potentially look at such a strategy, really, because I think it's been lacking, as I say, in the marketplace.
Okay, that's quite an interesting thought. So politically, do you think that there are going to be countries that people will look at and think, ooh, that's not one that I would have expected to be in there? And how do you then address that openly to begin with, or are you happy for people to come to you and say, I wouldn't have expected that? I'm not going to name a country because I'll get into trouble immediately. But that thing of saying, oh, I expected to see all those Scandinavian countries in there, but them, really?
Yeah, certainly. Certain countries do crop up from time to time, and I think it comes back to my original point when I said this is not going to be everyone's cup of tea,
Mm-hmm.
and I think a lot of people have their own biases, but I think that really comes back to we've tried to be as clear cut as possible with defining how we think about sustainability for this product and solution, and um, so may be it if people overweight their environmental thoughts versus how much weight they think about the social aspect of things. Really, I think a lot of people automatically gravitate to environmental commitments rather, and the social part of the ESG sort of gets downgraded, and that's where something like using the SDGs is a great anchor because it encapsulates like a whole host of E, S, and G metrics, really, and to my earlier point, puts a lot of equal weight on each of them, really. So that's why we try to remove our personal biases when it came to sort of developing the strategy and so forth.
It's quite awkward, that one, isn't it? Because it feels sometimes as though the environment has sort of trumped everything, and that the focus is too strongly there. So that whether it be social, civil, tax, for example, I find it my new thing is tax in terms of why is it not the first question that's asked in an ESG or an engagement or a stewardship? Because it seems to me as though corporate tax attitudes say an awful lot about corporate attitudes in general.
Hmm.
And I think that one. So when there's a change, I mean, I suppose you haven't been running the strategy for a sufficient period of time to go through a country that has changed significantly from a more liberal to a less liberal stance. And you look at the Swiss vote over the weekend, where the more right wing party that is, what are they doing? They're attacking woke, which is fascinating. I didn't realise that was actually a thing. But their environmental commitments, their etc. They are going to be dialing back on those. How far does that have to go before you completely reassess, or is it not particularly impactful when that changes? And if I dare mention the Trump in the room, if he were to come into the States, I mean, I know from an investment perspective that individual clients will say, I don't actually want US corporate debt anymore. Sorry, US government debt anymore, and that's quite awkward as well.
Yeah, some good points there. I think people through thinking about this, and what does come up from time to time is people can always point to a certain development and say, what about this or what about that? Roe versus Wade is a great example in the US. And I think it's fair to say, that hasn't been a great trajectory with respect to sustainability credentials of the US economy, but it's actually incorporated within some of the variables that I've discussed already. And you have to think of the broader picture in terms of there'll always be a negative, but there'll always be probably a positive to match as well. And you have to sort of weigh up how big a negative that is, should it sort of develop to really warrant a potential removal from the universe. Now, you touch on the US and Trump, for example. I think we've been relatively clear from the outset with regards to this strategy, and just to stress, our sustainable sovereign strategy alone is that, let's say, to paint a picture with Trump coming to power and decided to sort of pull out of the Paris Accord, well, it would then fall foul of our screening criteria because there would be no net zero commitment in place. And as a result of that, we would have to sort of remove the US from the universe. I think we would have a collective discussion to do that, and I think that would be the case. We wouldn't be able to invest in the US if that was the case, but we'd certainly have a very in-depth conversation before that occurred.
That's been really good. Thank you very much. That's jolly interesting. I
Pleasure.
like
Thank you for your time.
No, thank you for coming on.